Okeby Enterprises is the distributor for two products, Model A100 and Model B900. Monthly sales and the contribution margin ratios for the two products follow. Okay, you see that Model A100 has $700,000 in sales with a 60% contribution margin, while Model B has $300,000 sales with a 70% contribution margin. And the first part of this problem will answer the following question. Prepare a contribution format income statement for the company as a whole. Okay, now I've taken the problem and I've made it appear smaller so that we have room to put the solution down below. Alright, now you see the solution, and what we do is, since we know the contribution margin and the sales, we can calculate the contribution margin. We drop in the percentages for each unit. So they gave us 60%, so we drop that in, and we drop in the 70%. And then if we know sales are 100% and the contribution margin is 60%, then variable expenses must have been 100% less the 60% or 40% for Model A100. We use the same approach to come up with the variable expense amount for Model B. And once we know the percentage, we can simply multiply the percentage times the sales to come up with the contribution margin and then force in the variable expenses. If we do that for Model A and B separately, then we simply add across to come up with the total variable expenses and the total contribution margin. Well, once we know that the total contribution margin in dollars was $630,000, we can divide that by the 1 million of total sales to come up with the contribution margin ratio for the combined firm, given the sales mix that we had, and it's 63%. Then they also told us that fixed expenses were $598,500 in the problem, and we deduct that to come up with net operating income of $31,500. Okay, now on this slide I've taken the answer that we calculated to question 1, which was to prepare a contribution margin income statement, and I've made that image appear smaller near the top of the screen so that we can take a look at problem 2, which asks us to determine the break-even point for the company. And here's how we'd solve that. The break-even point is equal to fixed expenses divided by the overall contribution margin ratio. Well, using the answer to part 1, we've already determined that the fixed expenses are $598,500. In fact, that was given in the problem. And we divide it by the overall company's contribution margin, which is 63%. When we do that, we can come up with break-even in sales dollars equal to $950,000. Okay, next we take a look at part 3 of this problem, and it says, if sales increase by $50,000 per month, by how much would you expect net operating income to increase, and what are your assumptions? Okay, well now here's the solution. The additional contribution margin from the additional sales can be computed by taking the increase in sales, and they've given that as $50,000, times the overall company's contribution margin ratio. So that's 63%. And that comes up with $31,500. The reason that works is because we're not expecting any changes in fixed expenses. So all of the increase in the additional contribution margin falls all the way to the bottom line as increased net operating income. Now, the assumption that this makes is that the sales mix didn't change, and sales mix means the proportional percentage of every product that we intend to sell.